It is Tuesday, February 10th, 2026. And, I have to be honest, I spent this morning just staring at my screen. I'm looking at the market, then I'm looking at the economic headlines, and I'm genuinely wondering if my data feed is broken.
It is definitely one of those days. It feels like we're living in two totally separate realities.
Exactly. I mean, let's just lay it out. The Dow Jones Industrial Average just blew past another record. We're sitting over 50,000, historic high.
Right, champagne time.
You'd think. But then you look at the actual data that just dropped this morning.
Yeah.
And it's ugly. I mean, shoppers are gone. Businesses are getting nervous. So my question is, are we nuts? Or is the market just completely unhooked from reality?
We aren't nuts. And the market isn't. I wouldn't say it's unhooked, but it is running on a very, very specific and maybe a little cynical logic.
Right.
And that's really what we have to unpack today. We're going to connect those empty shopping carts to the green arrows on your stock ticker. Because there's this weird mechanism where bad news for the economy is suddenly the best news for your portfolio.
That's the paradox. But that's not all, right? We're also going deep on crypto. Bitcoin's taken a serious tumble. It's below $70,000.
Yeah, it's been rough.
And the headlines are all screaming panic, but the data is telling a totally different story, something much more mechanical.
It's less about fear and more about math. It's about institutional arbitrage. We're going to look at three very specific numbers that explain why the big money is selling.
Okay, I'm ready. We've got a huge stack of sources here. Interactive Brokers, Scotia Wealth Management, Investing.com, MEXC, Paul Hastings. So let's do it. Let's start with this macro paradox. Dow's at a record high, around 50,227?
Yep.
But the consumer data from this morning, it was bad.
So it was flat out disappointing. So the big number everyone watches is retail sales for December.
Right, the holiday season. That's supposed to be huge.
It's supposed to pop. The street was looking for, I think, 0.4% growth. What we got was zero. Flat. Nothing.
Zero growth in December? That seems like a disaster for retailers if you can't sell things during the holidays.
Exactly. And it actually gets a little worse when you dig in. There's a number economists watch called the control group. It's a slice of retail sales that filters out the volatile stuff like cars and gas.
And it feeds right into the GDP calculation.
That's the one. And that number actually went down. It contracted by 0.1%. The core of the U.S. economy just stalled out.
So what did people stop buying? Was it across the board?
It was pretty broad. The specifics tell the story, though. Furniture, down almost a full percent. Apparel, down 0.7%. Electronics, down 0.4%.
Well, so no new TVs for Christmas.
Apparently not. People basically only bought what they had to buy, not what they wanted to buy. Necessities held up, but that's it.
And I saw small business optimism sank, too.
It did. Missed estimates.
Yeah.
And maybe most importantly for this whole story, the employment cost index slowed way down to 0.7%.
Okay, translate that. What's that index telling us?
It's the Fed's favorite measure of wage inflation. It tracks how much it costs to employ people. A slowdown there means wage pressures are easing. People aren't getting those big raises anymore.
So, let me get this straight. Retail is dead, businesses are pessimistic, nobody's buying anything fun, and wages are slowing down.
That's the picture.
In any sane world, the stock market should be diving on that news. Why on earth did the Dow hit a record?
Because the market isn't trading on today's economy. It's trading on tomorrow's liquidity. This is the bad news is good news dynamic.
Ah, the Fed pivot.
That's it, 100%. When Wall Street sees data this week, it doesn't panic. It says, aha, the economy is in trouble. The Federal Reserve has to step in and save us.
So they're betting on rate cuts.
They are. Before this data, the market was pricing in maybe 2 rate cuts this year. After this morning, the odds of 3 rate cuts just shot way up.
That feels so cynical. Like, hooray for Main Street suffering, my portfolio's going up.
It is cynical, but it's mechanical. You can see it happen in real time in the bond market. Treasury yields just plunged. The 10-year is down to 4.15%.
And why does that push stocks up?
It's that competition for your money. When bond yields drop, bonds become less attractive. Suddenly, stocks look like a much better deal. Plus, lower rates mean cheaper borrowing for companies. That's why you're seeing utilities and real estate leading today. They love cheap debt.
Okay, so the formula is bad economy equals Fed cuts, which equals lower yields, which equals stocks go up.
That's the entire playbook right now. And it's not just a U.S. thing. Japan's Nikkei also hit a record high.
Same reason.
Similar logic. Hopes of massive government stimulus over there. It's a global liquidity theme.
Which I guess brings us perfectly to the other side of that coin. Because while stocks are popping champagne, The crypto market is having a massive hangover.
A big one.
Bitcoin's below $69,000. Ethereum's struggling. Usually crypto kind of rides the coattails of a big stock rally. Why the split?
This is where it gets really interesting, because the headlines are missing the point. This isn't about panic. It's about a very specific trade that just broke.
Institutional arbitrage.
Yeah.
You mentioned that. It sounds complicated.
It sounds it, but the idea is simple when you break it down. There are 3 numbers. If you get these 3 numbers, you get the whole crypto crash.
Okay. Hit me with number 1.
Number 1 is the Coinbase premium.
The premium.
Yeah, so it's the price difference for Bitcoin between exchanges. Coinbase is where the U.S. institutions play. Binance is more for global retail. For 21 days straight, that premium was negative.
So Bitcoin was cheaper in the U.S.
A lot cheaper. At one point by like $167. And that tells you definitively the selling pressure was coming from U.S. institutions. They were the ones dumping.
So much for the idea that institutions are the strong hands who are here to stay.
It definitely challenges that story. And that leads to number 2, stablecoin flight.
Okay.
Between December and February, $14 billion left stablecoins like Tether and USDC.
Now, hold on. Usually when people sell Bitcoin, they just park the money in stablecoins, right? It stays inside the crypto world.
Exactly. But this time, that $14 billion didn't just move to the sidelines. It was redeemed for actual U.S. dollars. It left the building entirely.
So institutions are selling, and the money's gone. What was the trigger?
This is the key. Number 3, the basis trade collapse.
Okay, I've heard this term. Explain it like I'm 5.
All right, so imagine a hedge fund. They don't care if Bitcoin goes to the moon. They care about guaranteed yield. For the past year, you could buy Bitcoin on the spot market and at the same exact time sell a futures contract for a higher price.
So you lock in your profit right away. It's risk-free.
Essentially, yeah. It was a money printer. In 2024, that trade was paying a 17% annualized return.
17%. Risk-free. No wonder they piled in.
Of course they did. But by early this year, that spread, that yield, it collapsed. It dropped to less than 5%.
So the math just stopped working.
The math broke. Why bother with a complex crypto trade for under 5% when you can get over 4% on a simple U.S. Treasury bond? You don't. So the funds just unwound the trade. They sold their spot Bitcoin.
So this whole crash wasn't fear. It was a spreadsheet decision.
It was a spreadsheet decision. The free lunch was over.
You know, the source material had that great analogy, the Starbucks one.
I love that. Bitcoin started as this cool indie coffee shop, an alternative to the system.
Right.
But to grow, it took on institutional money. It started behaving like a big corporation. And now you wake up and it's basically Starbucks. It might have the old logo, but the plumbing is all Wall Street. It trades like a tech stock.
That's a huge shift. But it's not all doom and gloom, right? There was a counter perspective in the MEXC report.
There was, yeah. An analyst there, Crypto Mick NL, he argues this is just a liquidity flush. He sees this $65,000 to $70,000 range as a big buying opportunity for, the smart money that's in it for the long haul.
So one person's exodus is another's accumulation zone?
That's what makes a market. And the government is getting more involved, not less. The White House just had a big meeting with crypto and bank execs. The Wild West days might be ending, but the regulated asset era is just starting.
Speaking of regulated assets and the real economy, let's jump back to earnings. Because individual companies are giving us a really clear picture.
Yeah, some clear winners and losers today.
Who is the big winner?
Hasbro. The stock was up over 7%.
The toy company. Magic. The Gathering.
That's the one. It seems even when people cut back on big-ticket items, they're still buying their trading cards. Plus, Hasbro announced a $1 billion stock buyback. Wall Street loves that.
Okay, so hobbies are still in. Who is the loser?
This one kind of hurts. Coca-Cola, down about 1.4%.
Coke? Wow. That's supposed to be the ultimate safe stock if people aren't buying soda.
It tells you the consumer is really feeling the pinch. Coke missed on revenue. It seems they've raised prices just one too many times, and people are finally saying no.
But the biggest drop, and the one I think is most fascinating, was S&P Global. Down over 9%. What happened there? This is a consumer company.
This is the AI twist. For decades, S&P Global has had this massive moat. They sell financial data, and if you wanted it, you had to pay them.
They own the information.
They did. Now the market is suddenly terrified that AI is going to eat their lunch.
Wait, I thought AI was supposed to be boosting stocks like NVIDIA and the chip makers.
It is, But we're moving into the next phase. It's not just about who makes the AI, it's about who the AI disrupts.
Right.
And if your whole business is organizing and selling data, a large language model can do that faster and cheaper. The market is basically saying S&P's monopoly might be over.
That is a fundamental threat to their entire business model. Wow.
It is.
Okay, before we tie this all together, let's quickly clear up a rumor about the government buying Bitcoin, this strategic digital asset reserve.
Yeah, we need to pour some cold water on that. We got clarity today from Treasury Secretary Bessent. He was talking about the Genius Act.
Great name.
It is, but the reality is less exciting. That reserve is just the Bitcoin the government has already seized from criminals.
Oh, so they're not going out and buying more on the open market.
No, not at all. They're just holding on to about $15 billion worth of seized assets instead of dumping it all at once. It's not a government buy-in.
That is a very important clarification. Okay, so we have covered a ton of ground. A record market, a crypto crash, an AI disruption. If you had to boil it all down to one single thread, what is it?
It's one word: liquidity. That is the only thing that matters right now.
Okay, crystallize that for us.
In the stock market, bad data means the Fed will likely provide more liquidity through rate cuts. So stocks go up. It's a liquidity injection.
And in crypto?
In crypto, the liquidity from that basis trade arbitrage just vanished. The yield dried up, so the liquidity left and the prices went down.
It's the same force, just pushing one up and pulling the other one down.
Exactly. You, as an investor, you're swimming in a pool with these institutional whales. You have to watch the bond yields. You have to watch these arbitrage trades. The headlines about panic and euphoria are just noise. Follow the money.
And looking ahead, there's a huge test for that theory coming up.
Friday, the CPI report, inflation data.
And that's the danger zone.
It is. Because if the economy is slowing, which we know it is, but inflation stays hot, that's stagflation. The Fed can't cut rates into that.
And if they can't cut rates,
This whole bad news is good news party ends fast.
we will be watching. But let me leave you with this final thought on Bitcoin. If it now trades like a tech stock, moves based on Fed policy, and is driven by the same hedge funds as the S&P 500, has it failed its original mission?
It's the big question. It was supposed to be a hedge against the system. Right now, it looks an awful lot like the system.
Or maybe that's just the price you pay for going mainstream.
That is the trade-off.
Something to think about. Thanks for diving deep with us.
My pleasure.